Morning, everybody. Live on Facebook, LinkedIn, YouTube, X, Instagram. We are good to go. Let me get back to my notes here. How's everybody doing on a Friday before Christmas? There we are. All systems go. Welcome, everybody. Let me get my comments up here for you. We're good on all platforms. It's December 2024, episode 317. Welcome to Mornings with Scott, the best damn business show for medium and small businesses on the planet. Markets continued to slide this last night, this morning, because of the Fed's mismanagement, largely, of messaging and Bitcoin. So I wake up and I'm preparing for this. So when I go to bed at night, I have my phone and I should not. There we go. I start the show with the holes in my mouth or my throat. I go to bed at night, I have my phone and I surf through the business news and I kind of cut and paste what I want to talk about in the morning. I get up and do that. I'm around 5 a.m. I start looking at how to plan this show, and I get up at Bitcoin's at 92,000. Now it's popped up since then. I'm not sure what it's up right now but my goodness, the world's falling apart, maybe, because sometimes Bitcoin is correlated. It goes along with equities. Equities have been crashing. Bitcoin has been crashing right along with it. So sometimes Bitcoin is correlated. It does the same thing. Sometimes it's inversely correlated. It does the opposite. It's like if you think it's a safe haven, well, gold is up. Gold is a safe haven. Bitcoin hasn't made up its mind yet. My view is that it is transitioning from what used to be a speculative play into probably in the long term a safe haven play. Who the hell knows? I continue with my thesis, and the thesis is that in the short to midterm, I like it a lot. I remind you, I'm not your financial advisor. I'm neither regulated, licensed, any jurisdiction, anywhere. Listen to me on business stuff, but don't listen to me at all on financial plays for your personal investment. But I like it a lot. And if you follow along on the show, you'll know our trading performance this year has been pretty damn good. And so some of that is Bitcoin. A lot of it is not, but some of it is. I'm bullish in the short term and midterm, but in the long term, it's going to zero. I don't think there's any doubt about that. Pierer, P-I-E-R-E-R, Pierer. I looked up on the AI this morning how to pronounce that properly. Mobility AG up 23% this morning, but still down 71% for the year. Now, you may ask yourself, why do I care? It trades in Switzerland. I've never even heard of the company. Maybe, but you've heard of the brand KTM. And by the way, for those of you on X that were chatting with me the last couple of days, this is not your deep dive on the KTM insolvency. Come back Monday. That's when we're going to do that. Please stay for the show. Enjoy. Throw some comments in. That's all good. But this is not the show that I promised you. So you don't have to sit through it if you're only interested in knowing what's going on with KTM. We're going to do that Monday live, 8:30 Mountain on Mornings with Scott. But why do I care about Pierer Mobility? Well, one is I'm researching it for what I just said. And Pierer Mobility is not in insolvency, but its main operating subsidiary out of what appears to be tens or dozens of operating subsidiaries is in fact in insolvency, in administration, in restructuring. And what does that mean? Those of you long-term listeners of this show, you know exactly what that means. It means your equity is going to get crushed. Your equity will be crushed. Why? Because insolvency, by definition, means there is not enough value to pay everybody. There's not enough liquidity to pay everybody. Therefore, someone's going to lose. Almost always, I shouldn't say almost always, I should just say 100% of the time, someone is going to lose. And who's going to lose? Well, it's the people at the bottom of the totem pole, so to speak, the bottom of the least powerful people in these situations, and that is the shareholders. They're going to get diluted. They're going to get crushed. And the stock's down 71% this year. What do we see over and over again? In every insolvent company that we follow, we see a bunch of public ones. We see a bunch of retail investors jumping into the stock and saying, wow, it's down 71%. It must be an all-time low. Maybe it's going to pop up like 20%. Well, it did. It popped up 23% today. It's got a lot of volatility, but I'm telling you, it's going to get crushed. And For those of you, another reminder, for those of you that follow the show, if you're trying to short this thing with options, I didn't even look up to see if Pierer Mobility has an options chain, but if it does, and you're trying to short it with puts, well, you don't write it to zero, because the most likely thing that's going to happen is the exchange is going to put a cease trade on it, and then you can never fulfill your contract, and you're screwed, just like I was on CanTrust, but we made lots of money on the way down. You'd have to be a long-term listener of the podcast to remember all that. Speaking of things that don't make sense, U.S. news last night was almost entirely. Remember, I told you I'm on my phone. I'm trying to come up with the show for the day, and entirely the news last night. And you and I are victims of the news on this show because it gives me things to talk about. Was about the failed spending bill in Congress. And so, if you're not paying attention, what happens is Congress, they wait till sort of the week before Christmas, and they put together, they don't do a budget. They don't do their job, what you're paid to do, Congress people. What they do is they put together a continuing resolution, and they throw all this stuff in there that really doesn't belong and has nothing to do with a budget or a continuing resolution. And they do it in secret, so no one knows what's going on. And then a week before Christmas, like they did a few days ago, they come out with a 1,500. You see, my camera's not even big enough to estimate with my hands the size of this thing. If you're on the audio version, you probably had a better experience in that particular example. And so they come up with this 1,500 plus page bill. And the idea is nobody gets to read it. You just have to vote yes. And if you don't get to go home for Christmas with your family. That's the strategy. They do it every year these days. And so they put a bunch of stuff in the bill that doesn't belong there. And the problem is this year, somebody read it. That doesn't ever happen. So somebody actually sat down and read the whole thing, and they didn't get away with it. And so there was an uprising in the constituencies and the voters calling their Congress people saying, hey, vote against this. And so they did, because it was horrendous. There was pay raises for Congress stuck in there. There was goodies for everyone except for you. That's what was in there. And why? Why did they read it? What changed this year? Well, DOGE, the Department of Government Efficiency with Vivek and Elon, and the left is shocked. The right is shocked. This is not a left-right issue. This is an establishment issue. Hey, this is how we got all this money for all of our pet projects and screw the public and create a bunch of debt and deficit. This is how we do this. What do you mean you read the bill? What do you mean you understand it? Here's my question. I put it on X last night. Why? Why are we so amazed that Elon Musk, the guy who literally was foundational in inventing artificial intelligence, which is a technology to review all of the data in the entire world and to very quickly, I'm talking in seconds, summarize that based on your prompts. Why are they shocked that this guy was able to read a 1,500 page bill? I bet you it took 2 minutes. I bet you it was like, hey, I uploaded this to my artificial intelligence. In his case, that would be Grok. Read this, summarize it. What's crazy in there? Oh my goodness, look at all this stuff. Like, obviously, the days of creating massive legal documents, including in Congress, but including in your business. If you're not using artificial intelligence to prepare and review documents in your business, you're crazy. You're just going to be losing. You can't hide things anymore. You can prepare things quickly without incurring the legal expense. I did a press release. We've had David Blair, a prominent Canadian cannabis industry expert, experienced in turnarounds and CRO work. He's security cleared. So he joined Sinclair Range, my company, as the head of the cannabis group. I did a press release on that yesterday. I didn't hire the PR firm. We did it on ChatGPT. It literally took about 30 seconds. 30 seconds. I just give it a couple of prompts. It's done. Earlier this week, we're making hopefully an investment and working with a cybersecurity firm. Did it by term sheet, by binding term sheet. Hopefully we get that signed back probably Monday-ish. We'll see how that goes. Did it entirely by artificial intelligence. Now, I know enough about term sheets to do this myself. I've been writing my own legal documents for a long, long time, because the last thing I want to do is go to a lawyer, Well, look, I'm not picking on the law firm, the legal profession, but you go to a lawyer and you say, hey, can you write? I'm thinking about investing in this company, and I want to do this and want to do that, and all of a sudden it's $60,000 later, and you really haven't thought through all the business issue. Best to write out a term sheet yourself and flush that out before going to the lawyers. So, continuing resolution, not pass, going to be a government shutdown, perhaps, but really, from a business perspective, who cares? It's going to be fine. This is all noise. This is not evidence at all that the world is falling apart. Don't let it impact your thinking in business. Don't get stressed about it. The business media is trying to create fear. It is a non-issue that will sort itself out. You want fear? Here's some fear. University of California, Davis tells us that the squirrels are carnivorous. They eat things that are animals. Squirrels. Yeah, that little squirrel outside your apartment or your house. The world is upside down. A ground squirrel with cheeks stuffed with nuts, seeds, or grains is common sight. But a new study provides the first evidence that California ground squirrels also hunt, kill, and eat voles. What the hell's a vole? I had to look that up. It's some sort of tiny little mouse rodent type of thing. The Journal of Ethology studies the fundamental change of our understanding of ground squirrels. It suggests that what was considered a I'm not even going to try to say that. They figured these things ate nuts. Actually, is an opportunistic omnivore and more flexible in its diets than we assumed. This was in 2024, this study in June and July, and out of 74 observed interactions, 42% of these squirrels tracked down, hunted, killed, and ate these little rodents. They have a picture in this study of a squirrel with the mouse hanging out of its mouth like it's a dog. I have nightmares from when I was younger, and I had my hunting dogs. We go on walks, and once a year, one of them would catch a squirrel. A German Shorthair Pointer would run and catch a squirrel, and shake its head and break its neck. It was horrible. But turns out, squirrel does the same thing down the food chain. We all live down a food chain. So the world is falling apart. Remember. But because of that, not because of a government shutdown. Remember, we know nothing about our world. Always challenge your assumptions. And the right answer is, for everything in life and business, is less hubris. More gratitude, less hubris is always the answer, including and particularly, especially in business. Speaking of hubris and its impact on business and deals, Wall Street Journal reported earlier this week what killed a $20 billion grocery steal, Albertson says Kroger did. Hey, you're saying, thankfully, Scott, thank you so much for finally getting to this damn story. You've been punting it all week. You've had it on the agenda. We didn't get there. We've been running out of time. I know. Well, we're going to cover it now. It's a week-old story at this point. But that's all right. We're not covering it for current news. We're covering it because we can take some lessons about this. So Wall Street Journal says within months of Kroger announcing a $20 billion deal to acquire Albertson, Kroger made missteps that Albertson said ultimately sank the supermarket mega deal. A tie-up between the two largest U.S. grocery store operators was bound to draw scrutiny from government, antitrust watchdogs, and consumer angry about climbing food prices. You try to merge big distribution grocery stores. I don't mean distribution in terms of wholesale. I mean distribution in terms of this is where I go get my groceries. You try to merge these things together in a political environment of hyperinflation focused on food. People can't buy their eggs because of bird flu. You're stepping on the hot plate, so to speak. Lawyers for Albertson accused Kroger of losing interest in the deal after a pandemic-fueled surge in its profits began to cool. Are you sick of hearing about businesses complaining about COVID? When I meet new clients, they want to raise money, they need to make some profit because they've been on a little losing streak, and I'm the guy they come to fix this problem. And what I hear over and over again is, COVID. We came out of the pandemic. COVID. Enough. It's been years. You haven't dealt with this now. It's not the pandemic's fault. It's your fault, right? And so, anyways, these guys are saying that Kroger lost interest after the pandemic-fueled surge and its profits began to cool, and its stock price declined following the October 2022 merger announcements. So, you're a grocery. Hey, Catherine, thanks for joining us. Absolutely. is her comment on the sick of hearing about the pandemic stuff. So basing, I should check my Instagram comments as well. Hi, all that have joined us on Instagram. Thank you. So look at grocery stores and other industries think power sports, because we're going to talk about KTM and Pierer Mobility on Monday. If you've tuned in for that, the deep dive on that is not today. It is Monday. You don't do a deal. You don't make strategic decisions based on inflated, unusual, abnormal pricing, inflation, and activity in your business. So in power sports during the pandemic, everybody was out buying motorcycles. Bombardiers has gone through a restructuring in Canada. I noted somebody else in the U.S. I didn't cover the story, but they're a military manufacturer, but they also make what do they call those things? 4x4s, not 4x4s. That's not the right word, but basically off-road vehicles of some sort. So, they're restructuring and they're cutting down on that. That bubble is over. Do not make your business decisions, your strategy, or your deals based on the bubble. Do your buying. If you are buying, you can't buy in bad time. You want to buy in bad times. If you have the cash, buy when things are down. If you need to leverage your acquisition, you do it when things are medium. When things are medium, because there's available capital, but the prices aren't crazy, and you're not diluting yourself in terms of valuations. And if you're going to sell, obviously you want to do that in the good times. So good for the Albertson people for wanting to sell at the top of the grocery bubble, and bad for the Kroger people for wanting to buy at the top of the grocery bubble. There's a Charlie Munger story, Warren Buffett's partner. I don't remember what it was. I'm going to look it up sometime because I love the story. But he tells a story about a horse, and it's beautiful and everything's awesome with the horse. But every now and then it would just turn on you and buck you off and try to stomp you, and just had an ugly side to it. And they asked the horse trainer what to do. And they said, well, wait until he's behaving well and sell it. And that was a story about private equity. That's exactly what they do. You're going to sell, do it when things are great. But if you're going to buy, don't be sucked into that, and do not make strategic decisions at the height of a bubble based on hubris on buying your own, reading your own press releases, as they say, as I think is the situation with KTM and Pierer Mobility that we're going to cover on Monday. Kroger derailed the merger after suffering a classic case of buyer's remorse, according to the complaint, which sees at least $6 billion and seeks at least $6 billion in damages. Kroger and Albertsons pitched their deal as creating a bigger competitor to mega retailers such as Walmart and Amazon. And to address the competition concerns, the companies offered to sell 579 grocery stores to distributor C&S Wholesale Grocers, but the FTC earlier this year sued to block the deal, claiming it diminished competition and would lead to higher grocery prices for consumers. This is the same FTC, by the way, the regulator that thinks that Google should sell Chrome, the browser, as if anybody uses that anymore for search. If they Google anything, that's not happening. But anyways, the FTC is always years behind. They're not acknowledging or understanding that the bricks and mortar people are not keeping up very well with the online people. And so, anyways, FTC stopped it. Bad regulation, in my view. Kroger took the lead on efforts to secure government approval on the deal, according to the company's merger agreement. I think they have who said this? The CEO of Albertsons said that Kroger has got the experience to do this. But now, after it's all fallen apart, Albertsons now alleges that Kroger's divestiture plan ignored more qualified grocery store buyers, and that Kroger's insistence on only one company taking control of the store's limited range of purchasers. And Cerberus is involved. This just goes on and on and on. In February, meetings with the FTC, Kroger pitched divesting itself of 541 stores. So the bottom line is they're trying to merge these huge grocery store companies together, and then the acquirer, Kroger, said to the regulators, to the FTC, hey, don't worry about this competition issue. We're going to take 541 stores and we're going to sell those so that we're not as dominant in the market. And what Albertson is saying is, hey, you tried to sell all the crap stores and keep all the good stores. So that didn't really meet the needs of the regulator. I'm not saying that's true. I'm just saying that's what's alleged. And obviously, Albertsons is trying to get some dough. You like that joke? I like that joke. Albertsons is trying to get some cash out of the deal, and Kroger's saying that's not the case. And Kroger thinks that they had a deal with the FTC, with the regulators already. And then there's all sorts of discussion online and the newspaper about, hey, this is the new world of regulation. They won't answer you up front. They're going to be unclear, right? This is the whole Bitcoin regulatory discussion we've had in the past on this show. They're going to block your deal. They're going to make you waste time and money. This is not new. That is the business of regulation. That's the way they operate. There's no scenario where you can walk into a regulator's office, which I have tried to do when I was younger and dumber, and sit down and say, hey, here's what I'm thinking. Here's sort of the options. I just want to make sure you guys are on side and I'm doing the right thing. They won't answer you. If they do answer you, it's not going to be necessarily the truth. It might be the truth by coincidence, but they're not going to take a position. They're not going to stand by it. They are not there in their minds to help you. They ought to be, but they're not there to help you. They're there to cover their ass and do whatever their taskmasters are asking them to do. And that's the way regulation works, and it's the way it has always worked. And by the way, I've been accused privately. People don't always comment directly on the show, but what they do is email me relentlessly and send. I love it, by the way. Thank you for being engaged and sending DMs. And I say, hey, you're against regulation. I'm not. I'm actually really pro regulation. What I'm against is regulatory regimes that do not work, that kill business, that hamper business, that are secretive. I don't like this secretive, that are fluid, they're deceitful. If you look at the U.S., go back to the Obama days and the coal industry, for example, and fracking with Kamala Harris. What did she say? She says, I'm totally for fracking. So that's what they say on one side, but then they kill it with regulation on the other side. It's impossible. And they go after the financial industry to not finance it. So if you're trying to frack something, and I'm not saying you should or should not be in favor of fracking, I'm just saying if you are, you can't do it anyways because you can't get the cash and you're going to be regulated out of existence. That was the plan with coal. And, there's ebbs and flows. Sometimes they think, oh, we need some fracking. And so they change their mind on that. Here was another part of this Albertson story that I liked is both companies have spent more than $1 billion in professional fees combined and legal and other fees associated with the transaction. So they spent 2 years on the deal and $1 billion to fail on a process. Deals need momentum. Businesses need momentum. If you've been working on a deal for a year and a half, you're not going to get that deal done. You need to change something. You can't do the same thing over and over and expect to get a different result. We talk about that a lot. I've told you that I have a business course. You can find a link to that in the notes. And module 3 is about momentum in business. And here is the absolute truth. If you have positive winning momentum in business or in life, it attracts resources. It attracts people. It attracts cash. Because if you want to work for a company, do you want to work for the company that's got a good buzz and is doing better and is happy in the press? Or do you want to work for the company that sucks, that is losing, that everybody knows is going down? You want to work for the company that's going up. If you're an investor, same thing. Are you going to invest in a company that's got great momentum, or are you going to invest in the company that's going down? Winning momentum attracts resources, both human and financial. Losing momentum or no momentum repels. And the bigger the losses of momentum, the more it repels human and financial resources. Same with deals. Deals need momentum. I'm right now in the middle of a couple transactions, and I am super stressed about things just dragging out, not having momentum. People come to me. I've had 2 in the last month or so to do a deal, to raise some capital, to build a company, to be a founder, what have you. And they've just been flailing on this forever. And what I spent a lot of time thinking about is, okay, how do we reset? How do we, shake the box, as they say, and come out with a different result and generate some momentum to get this deal going? And then we need to stay on it. 2 years, $1 billion in professional fees and a failed process. Take a look at that module 3 of the course in the link if you want to do that. Just check my Instagram comments here. All right. What are we doing? We're 26 minutes in. Let's tackle this next story about regulation. Well, as I said, I'm pro-regulation. It's the only way to, I think, the proper way to protect the social good, whatever that might be. I may not agree with the social good plan, but regulation, I think, is the right way to go about that. But what I'm against is regulatory regimes, as I said, that don't work, that are secretive, that are deceitful, that serve to crush the smaller players. Think of, we talked about this a few weeks ago, the Canadian investment dealer brokerage industry. The securities regulators have wiped out the lower tier of those broker dealers, if I could put it that way. We don't use that term in Canada, I don't believe, but what my US audience would think of broker dealers. And that in turn is wiped out for at least a while certain industries. Like we don't have any junior exploration to speak of anymore, because if I want to go buy a couple of shares of XYZ, which is drilling or looking for gold or rare earth minerals to sell to the US, my bank dealer, my securities dealer, the people that manage the funds, as a broker, they don't manage it, but I trade through them. They won't let me do that based on the KYC, the know your client rules, and just the regulators cramping down on them. So the regulators in this case have wiped out an industry, but they don't tell you that. They don't tell you that, but don't think they don't do it on purpose. They do it on purpose. So that's what I'm against. But I do actually love smart regulation. Financial Post reports that a protracted downturn in natural gas prices has battered the balance sheets of some oil and gas producers in Western Canada, driving insolvencies in the sector to their highest level in 3 years. The number of producer bankruptcy, receiverships, credit proposals, this is all the same thing. This is all just a restructuring, bankruptcy stuff, was for the oil and gas industry in Canada was greater in 20. By the way, why is it great in Canada and not the US? Well, the answer is going to be regulation. When we get there, was greater in 2024 than in previous 2 years combined, according to the analysis of Financial Post, court filings, yada, yada, insolvent and Insolvency Insider. By the way, Insolvency Insider, which is a great online journal newsletter, maybe newsletter is the right word, in Canada for insolvent companies. It's really he's done a great job. Henry's done a great job on that. And I have been invited to speak in February to lenders in Calgary, to a group of lenders on various trends and insolvency and turnarounds and other stuff, of which I may or may not be an expert. So I'm excited about that. We went to the planning stages, and as the time comes, I will give you more information. I think it's an exclusive list, so you can actually go watch, but maybe we'll get some video out of this. I'm not sure. I'll talk to the Insolvency Insider guys about that. There have been at least a dozen oil and gas producer insolvencies so far this year, compared to about 5 in 2023 and 3 in 2022. The largest of these is Calgary-based Long Run Exploration. Long Run Exploration Limited, which is attempting to restructure. It was about $308.5 million in environmental obligations, which, because of regulation, will trump, I believe, the unsecured creditors at least, and perhaps in some instances, the secured creditors. If the restructuring fails, it's feared that the 4,800 licensed wells and 523 facilities are going to fall to the responsibility of Alberta's industry-funded Orphan Well Association. Environmental liabilities were a key driver in a number of the insolvencies in the oil patch in 2024. So again, this falls to regulation. And well, let me finish this and I'll come back to it. So under the old regime, if you had a bunch of inactive wells, it wasn't much of a problem, says a lawyer from Bennett Jones, Keeley Cameron. But now our inactive inventory is resulting in increased spend requirements annually. And so what's happening is the regulators are making the smaller, well, all companies, but it impacts mostly the smaller junior companies, post bonds security bonds is like, okay, you can have your permits, you can do all your drilling here, but you need to put up financial assurance that you're going to clean the thing up. And then they're putting equally which is fair, right? I mean, that seems like a really good idea. And then they're also putting pressure on these companies to actually clean them up. And so, and then to put some teeth to it, there was a legal decision, which you should not listen to me for the legal interpretation of that, but it put some question into whether these obligations rank ahead of or behind the secured creditors. So now you can't go out and get financing. It's difficult. I'm not saying you can't, but it's hard to get financing for new projects. And there's pressure from the regulators, which makes you spend a bunch of more money. And it's driving these companies into insolvency. And what's going to happen? All of these wells are going to go back to the provincial government in Alberta, and the public's going to clean them up anyways. And so I think this is an example of regulation that isn't working. I do not have a better idea, by the way. Usually I have a better idea, but I don't really have a better idea in this instance. I've never done a deep dive into it to think about the policy on that. But I did find this story interesting from the National Post. It seems to me like a collection of well-intentioned regulations that are not working, are putting companies on the brink of insolvency, and it's not serving the public good, because the wells end up back anyways. It reduces exploration and smaller businesses that create jobs. There's all sorts of bad stuff related to this regulatory regime. We ought to think about how to change that. And since I'll be speaking in Calgary at this lender conference, maybe I'll do a deep dive on that. And because this is an oil and gas town up there in Calgary. There's just one last piece of the story I want. So Ericsson, which is the company, one of the companies that has gone insolvent, they had a burn rate of $250,000 per month, which I don't know. I've had a burn rate of $250 a month forever. 20 years, I think I did that. So I'm not. Anyways, apparently they couldn't raise the money. Maybe that was the regulatory side, but they have a solution. Court documents show that the company recently struck a $2 million deal with, this makes me laugh, with a Las Vegas-based cryptocurrency miner, Griffin Digital Mining Inc., and they're going to buy all this oil and gas reserves that Deloitte valued at $105 million. They're going to buy them all for $2 million. By the way, just because Deloitte says reserves are worth $105 million, that does not mean that you can make $105 million off that. But the crypto miners coming to save the day of these wells of this Ericsson oil and gas company. And it says if the sale proceeds, it would prevent Ericsson's assets from being orphaned. So it's just going to punt the problem, while also, and the problem will be taken over by Griffin probably, securing a fuel source and a gas plant to power Griffin's cryptocurrency mining operations, according to those familiar with the purchase. Back in the day, when Bitcoin was first founded and everybody wanted to be a miner, and I was doing some oil and gas work, turnaround restructuring work in the Calgary Red Deer, Lacombe area. And my receptionist at the time was telling me about, I think it was people in Saskatchewan that were taking tractor trailers, like 18-wheeler trailers, whatever size those trailers are. I should probably know that, but they built them out as kits to be miners, and you could drive around from community to community in northern Alberta and northern Saskatchewan where the gas was super cheap and they were just flaring off, and basically get free energy, which is required to mine Bitcoin, apparently. So that was the business plan. That tells you things were at a bubble back then, which they were. It burst shortly after that, but then obviously rebounded because we are bullish today on Bitcoin. Let's wrap this thing up. That's it. I'm done with this. And for the day, hey, the Pierer Mobility AG, which is not an insolvent company, is a public company, but does own the KTM brand and other brands. And the KTM brand, the main operating company, is in insolvency. We're going to do a deep dive on that, as requested by some listeners and enthusiasts of that community. It's not going to be a lot of specifics, but it's going to be some pretty hard conclusions. And if you're buying that stock right now, because as I said when I opened, it was pretty up. If you're buying that stock right now, I'm not your financial advisor, but you need to think long and hard about a company that's going through a restructuring process, which means by definition, there's not enough value for everybody. And the very bottom of that pile is the equity holders, the stockholders. It's not going to do well. I don't foresee this going well. Think about that. Hey, I'll also tell you, I think Monday might be the last show for a while. I don't know what you think. Maybe I'll do some over the holidays. Probably won't, but we're probably just going to punt till 25 and take a little rest on this. Thank you for watching. This has been Mornings with Scott. We'll see you Monday morning, 8:30 a.m. Mountain, and we'll be talking about KTM.